All right, welcome back to the Jason Gray Show. Hope you're all doing well. Go ahead and like and subscribe if you enjoy this content, and I appreciate it. All right, so the CPI report came out this morning at 5:30 this morning. Came in great, right? Came in really we're anticipating everything. The core rate came in at 0.4%. The year-over-year number came in at 6.0%. The core number did come in a little high at 0.5%, and a lot of that had to do with shelter cost. So shelter cost is unfortunately a lagging indicator, and these numbers are really struggling to sort of come into the mix here. And Barry Habib over the MBS Highway had a great video on it this morning. He was talking about how this sort of lags about 12 to 14 to 15 months after things start happening, that you sort of see those results. So let's go to the next screen here really quick. And this is called the shelter costs that are lagging. And you can sort of see the little blue line here, and it sort of just goes straight, dips a little bit, then comes up. And then you see the purple line that goes straight, dips down a little bit, goes skyrocketing up, and then comes down. And if you look at the numbers below here, you can sort of see the dates. And you can sort of see about a 14-month gap between these numbers start rolling over, and we really think that's going to start rolling over in the next 2 to 3 months. Now, if that shelter cost was out of the mix, that CPI number would have came in right about 3.3%, which would be more in line with where the Feds are at. And Barry made a good point this morning. The Feds know how to read these charts and these graphs and this lagging indicator stuff. And the Feds took the market to the breaking point over the last couple of days. That those couple banks went under. They overtook 3 banks. Monday was not a great day for the banking stocks. Today was a great day for the banking stocks. So maybe all's okay now. Who knows? But really, they broke the market. And what I mean by they broke the market is a lot of these banks had these bonds at a very low yield. Let's say about a 2% yield, and because they were giving us a savings rate of 0.5% or 0.25%. Well, as the Feds have increased the short-term interest rates, what has happened? All these people are pulling money out of this very little yield over here, and they're rolling into like 6-month treasuries or 1-year treasuries that's yielding like a 4 or 5% yield. And unfortunately, the banks are sitting here with this 2%. And what happens if you're over here at 5% and they're at 2%? They're going backwards. And so that's what sort of broke the banks a little bit. So is it all over yet? No, but the next 60 days can be a little shaky for us. I'm going to tell you why. Let's go to the next chart. So this is the replacement data from 2002 to 2023. Sorry, 2022 to 2023. And where we're at right now is we're on the March 14th one. And you can sort of see there's a pretty good gap there between the year-over-year data. But look at April 12th. April 12th, there's a small gap here. So I think over the next 60 days until we get to the May 10th report where there's a big gap again, I think that's when things are going to get better. Now, I've said this now for probably the last 3 months about this information. I really think the end of the second quarter to the beginning of the third quarter, I think these numbers are going to start looking pretty good. Not only do we have this gap on the year-over-year numbers, but that lagging indicator on the CPI report is going to look good. And that number, what should look like, let's say we hit 14 months into it and we're now into the May 10th, reporting date. If all that sort of happens together between the housing expense go down and those year-over-year numbers hit, all this should actually come together where I think this will all happen. Now, for the next 4 months after the May 10th, all these numbers should look good to us. Those year-over-year numbers they have big gaps in there. So let's look at the very last chart. And what I want to look on the last chart here, and I'm going to have to scroll down here. So if you look at the bottom right-hand corner, and you sort of see that, we had some crazy candlesticks here on the market. And candlesticks are, you see the stock open, and then you see it close, and then they have these little wicks associated with it. And these last 3 days have been crazy. They're called the falling star candlesticks. And I've never seen this pattern in quite a while. And what happened here is we had the banking stocks struggle. We had the Federal Reserve have to step in and take over ownership of a couple of these banks. And in turn, the bond market rallied, right? It was a flight to quality. What did that do to our mortgage rates? Our mortgage rates got better about 0.5% in mortgage rates, which is great. Now, we bounced off the 25-day moving average today. The very far right-hand candlestick here, you can sort of see it hit the 25-day moving average, bumped off of it, and right now as we're talking, we're just right above it. If we hold this level, and the PPI report comes out tomorrow, not only does the PPI report come out tomorrow, but the retail sales reports comes out tomorrow as well, and builder sentiment comes out tomorrow. All those things can move the market dramatically. I think the builder sentiment report is going to look horrible, and I think the retail sales are not going to look so great either. Like I said in my previous video, the retailers are struggling right now, and they have a lot of inventory, and they need to unload that inventory. It's a rough time of the year for them to sort of unload the inventory, so it could be an interesting next couple days. We're cautiously floating rates right now. If you're in contract, I've locked in my pipeline currently. Just because the market's so volatile, I just don't know what's going to happen tomorrow or the day after, and it's not worth the risk of the market moving and dealing with the stress associated with floating that rate. If the market was going into a positive swing that's really consistent and not these violent swings going back and forth, it would be a different story. But these are some pretty dramatic swings day in and day out. So hope you like this content. I'll do another report tomorrow about the PPI report. Let's see how that looks, the builder sentiment and the retail sales. Hopefully you like this video. Like and subscribe. Thank you very much. Bye-bye.